It is your realtor Hugo here with another live night. Happy 4th of July. You guys did amazing. Congratulations on making it to the hit list. You guys are it. The A1 day ones from the round the way, I guess. I really appreciate all the feedback on the last couple of lives. I know the video was pretty choppy, but I really do appreciate you all at least bearing with. And more than anything, this is a great opportunity for us just to powwow and kind of talk and hash things out about what's going on in the market and also what's going on in my life so that I can maybe help you all a little bit more with your lives. Now, today we're actually going to be talking about a very interesting phenomenon that many people know about, but few people are actually involved with, according to new statistics saying that about 40% of Americans are not invested in the stock market. So I have made it my prerogative to educate as many people as possible on the beauty of the stock market. So today we're going to be talking about investment tips on how you can take advantage of bull markets and bear markets. And we're going to talk about what those mean and just a very introductory course on stock market analysis and what to look for. So for your mental health check-in, we're going to be talking about your finances and how to invest wisely and share it. We're on all major platforms. And if you don't see me, then I'm sorry. I no hard feelings. All right, so maximizing market potential, tips for bull and bear markets. Um, what is a bull market? It's a period of time of rising asset prices and investor optimism. Key characteristics are high trading volume, increased investor confidence, and rising stock prices. What is a bear market? Bear market is a period marked by declining asset prices and widespread pessimism. People are usually like, I don't want to invest right now. I don't want to have so much money tied up in a company. I just really would like to have it maybe in cash or in savings. Key characteristics are low trading volumes, decreased investor confidence, and falling stock prices. Number four, diversify your portfolio. Tip really number one is diversifying your portfolio. In a bull market, you look for growth stocks and sectors and really tried to focus on those. When we saw the last big bull market, which is the one that we've kind of run into right now, is technology based, energy based, solar based, Tesla and Nvidia fueled. But we've seen huge innovations in technology with some of the biggest um, assets right now being uh, in the technology sector. So knowing what sectors are rising, what sectors are falling, these are all key things to look for. And diversifying your portfolio lets you take things. When things go up, you win. When things go down, if you're diversified enough, you hedge against the things that are going down so you don't always lose or don't lose as much as you would if you were just all in on stock alone. In a bear market, include defensive stocks like utilities and consumer staples to mitigate risk. Why utilities? Utilities are things that everybody needs. There's no going around it. We want to have our electricity, our water, our gas. That's the type of stuff that we're talking about. So, one of the biggest things that we saw over the weekend was Morgan Stanley's energy fund being highly advertised in TikTok, and a huge influx of people putting money onto that, hearing that they could make about $3,000 a month. Well, $3,000 every 90 days if they invested X amount of money into that fund. It's a mutual fund. Comes with its own risks and rewards. Obviously, any investment comes with risk, and investing in the stock market, you should basically understand that any money you put into the system can go down to zero unless you put a stop loss, or maybe not even then, because sometimes there are just out of this world cases when it comes to the stock market. And there have been companies that have just been seized or restructured or go into bankruptcy, that all of a sudden that money's just gone, like the South Park meme when bankers like, and it's gone. Stay informed. Tip number two, stay informed. In bull markets, follow market trends. In the news, really identify the rising sectors. And in bear markets, monitor economic indicators and company earnings for undervalued stocks. If you're seeing a company that's not really getting a lot of traction, um, and you see them consistently do good work, beat earnings, have good earnings calls, have good communication with the stockholders, I would keep investing in something like that, and you never know where it could go. I've had huge wins in companies that many people haven't looked at in decades. And it's just a matter of really looking at what's important for what's happening now. Because everyone wants to be hip, cool, new, fresh, even older brands. So understanding how brands adapt in any market will give you a better understanding of that brand for the future. Look at Coca-Cola, look at McDonald's, look at Walmart. Those are all things that you want to look at. In bear markets, you want to look at those undervalued stocks, and in bull markets, you want to look at the things that are rising. Um, when things go well for everybody. When things go bad for very select people. So you want to make sure that you don't end up on the wrong side of history. Tip number three, utilize dollar cost averaging. This is a great technique for someone that doesn't really perhaps have a lot to invest in a stock portfolio, but it gives you the exercise and the reps of putting money into this account, starting to fund investments, seeing how the investments rise, seeing how the investments fall, feeling out your investor risk and feeling out how much it is that you can really play with on some of these moves. It took me a long time to break a personal barrier for me of $100 per stock. Why? Because at $100 per stock, when you really start to break down how much money that is, the losses are so much greater than some of the wins sometimes. And if you're not very keen on what's happening, you could lose a third or more of what you have invested very, very quickly. So, utilizing dollar cost averaging in bull markets is consistently investing to average out purchase pricing and reduce market volatility. So, in other words, you keep buying consistently, either weekly, monthly, bi-weekly, whatever it is that your interval is, and you keep purchasing the same amount, no matter the price. What ends up happening eventually is that all the different purchases are going to average out to a certain number. On average, if you do this, you will have an overall lower number than the highest peak of that stock. Hopefully, that stock continues to go up, so you will always be under the maximum value. You will always be gaining if you dollar cost average. So it's a very easy way to think about it in the sense of like, hey, let me put money into the stock market instead of into a savings fund. But again, remember, the bottom can go out on the stock market, whereas in a savings fund, it is at least, well, in a bank. And I say that reluctantly because we all know that the bottom can go out of a bank too nowadays. But it's a whole new world. Bear markets. Continue to invest to accumulate shares at lower prices, benefiting from future recovery. When it's times are tough and people are scared, that's when you want to invest in the stock market. You want to keep money on the side when things are scary and everything's in the red. Days like today are a great day to invest. Bitcoin tanked by almost 30%. It's at an all-time low for any reasonable amount of time. And we had huge crashes in the altcoins. So the potential upside on all of this is there now. There's a lot of people and they're getting it. They got a gift on the 4th of July. So there are a lot of moving parts to all of this and a lot of things that are happening um, at the same time. So staying aware of this stuff can get sometimes taxing. Dollar cost averaging again helps you with that because you don't have to stay on top of these things. If you know what sectors are the cool sectors to be in, if you know what markets are the cool markets to be in, if you know what companies and what projects to be on, you could dollar cost average them $5, $5, $5. It can amount to something someday. It's not going to be the maximum amount that you might eventually have if you have all your chips in one basket, but it's going to be more than your neighbor that didn't put any money in or just kept it in his savings account. The last thing you want to do is let money rot. Remember, it's not eternal. Money does have a lifespan. So it's use it or lose it. And it's the best way to make more money is to use money to produce more money. And it's just a repeating cycle. Eventually, you can take some money off of the top of that, but we're still a long way away from that. We're still just talking about bear and bull markets. Number four, maintaining a long-term perspective. Bull markets, you really want to avoid selling too early and ride the wave of growth. It could take some time, so you just want to be patient with the process. There have been some stocks that I've been sad to invest into and dollar cost average into. I'm seeing the thing go down week after week after week, and I'm like, I hope this goes up someday. But you do your research, you do your math, and you pray. You hope that you have done your research and your math, and you understand the charts are going the right way. That's really how that works. Um, in bear markets, you stay patient, you avoid panic selling, and focus on long term potential. What is panic selling? You start to see a crash like today. There were a lot of people that were tricked into selling today because they thought that today was going to be the end of the world. That is how this game works. Every day is the end of the world to somebody. So, stay aware of that. Understand that there are ebbs and flows in every market, and there are narratives in every market. Right now, one of the biggest narratives is energy. One of the biggest narratives is AI. One of the biggest narratives is commercial real estate. And one of the biggest narratives is healthcare. So, those are all things that if you look into those sectors and see, hey, these stocks have been doing well for the last 3 years, this could be a good sector to invest in. That's how you safely walk into a market. There are also great trading platforms like Webull or Robinhood that you can actually start a profile on there for free and fund it for free and play around with fake chips, so to speak. You put money into a stock. The stock runs exactly like it runs on the normal stock exchange, so you get the same returns and tax implications and everything else is there. So it's a real scrimmage game. You're really playing a match against the system, and you see if you can make money. My one of my first brokerage portfolios, I did that and I lost. You try it, but it's once you lose it, you lose it. So it's like it's actually like almost real money, and it really gets you into the mode of thinking, well, like, oh, okay, this is how I can make this grow, or this is how I can make this safer so that I can grow steadily. That's what you want. You are very slow to rise in the stock market, but very quick to fall in the stock market. So always be prepared for those falls so that you can take advantage of the discount. But do your research so that you know that when you're buying that piece of asset, that it will eventually go up, and that's why you're investing in something good. Don't invest in something that you're going to regret later on, or really becomes a liability more than anything else. Tip number four: maintain. Oh, excuse me, we talked about that. Avoid panic selling. Rebalance your portfolio. That's tip number five. In bull markets, you want to take profits, rebalance to avoid overexposure to overvalued assets. That's why you diversify. When you are able to take some money off the table, which is usually around tax time, a little before, a little bit after, depending on who you are. What you want to do is look at your portfolio and be like, all right, Nvidia had a 400% run up this year. Let me take some chips off the table. Not all of it, maybe like 25%, maybe like 10%, maybe like 30%, whatever it is that you feel comfortable taking, but a portion no larger than 30% of your earnings and take it off the table. Just cash it out, keep it on the sidelines, in cash, in the account, or take it out and use it for whatever you need. My highest suggestion would be you take that skimming off the top and you keep it in the brokerage account. Wait for those crashes when you get like a 30% drop on Bitcoin or you get like a 30% drop on your favorite stock and go in. Use that money and go in. It's already in the brokerage account. You've already committed it to investment into your future. Use it for more investment into your future. These could be other opportunities that could help you grow because the worst thing to do is buying an overpriced stock. But the best thing to do is to have money available when the stock does crash so that you can take advantage of those moments. And boom, when the company recovers, you're right there with them. Um, in in bear markets, what you want to do when rebalancing your portfolio, you want to reallocate funds to take advantage of undervalued opportunities. So when things are starting to chug along and you do have the assets, that's where you really do invest. Number or tip number six, invest in quality companies. In bull markets, you want to look for companies with strong growth potential and solid fundamentals. And in bear markets, you want to focus on financially stable companies with a history of weathering downturns, excuse me. So you want to look at your blue chip companies, your staple companies. By blue chip, we're talking about companies that are usually producing a dividend that gives money back to the stockholders, or that it's a company that's been around like a legacy company. It's a tried and true company, and a lot of people really have invested a lot of money. Usually, you're talking in a market cap of the billions or trillions of billions of dollars. It's a lot of money at that point. So these companies don't immediately fail. They just restructure or get bought in or absorbed somewhere else. We're talking about a Disney, Berkshire Hathaway, Google, Amazon. These companies are so large, there is no failure here. It's more of like, where would everything go if there was a failure? Which is a very different question than, for example, like an Express that just went out of business, that everything must go. You just got to settle everything because it's just like they haven't made money in so long, they have to pay debts. And tip number seven, use stop loss orders. This is something I talked about earlier. If you are not familiar with a brokerage account, stop loss orders can really save your life. And what they are is basically like a break. You buy your stock at X amount right here, right? It goes up, you're happy. It all of a sudden crash down to like a horrible level. Say like you just lost like 90% of your value. What do? Do you wait and just wait and see if it kind of climbs up again? Or do you have what's known as a stop loss? And the moment that thing starts to go down, you have set a number, a specific price that you will sell, emergency, everything. Once you set that price, your order will execute if the amount goes down that low. That's why you have to be careful with the stop loss because sometimes there are crashes. There are little like maybe blips where there's a dip, there's low trade, someone does a big move, a whale move, a lot of people. And then all of a sudden you sold everything and everything just bounced back and you're liquidated. You just lost your position. You don't have any chips on the table. So that run up, you lost all of that potential money just because you were unprepared for that stop loss. You didn't understand that it was either too high or too low. So I personally don't run stop losses that are very high, meaning that they're usually not very close to my actual position of where my stock is. But it doesn't mean that I don't use stop losses. You have to. There has to be a certain point. Like, unless you're to that point in your investment, and you're that type of risky person that you keep just everything running gun and just like, hey, let me props to you. But I unfortunately I have mouths to feed and I have, people to save. Like I can't lose all my money. So, it's like just one of those things that really you have to, more than anything else, understand your risk tolerance. Do you think that you can put up with losing everything? Are you okay with losing everything? There have been points in my life where I've been fine to let it ride. When I had Bitcoin investments, that was a long-term investment. So I lucked out that it worked out. But nowadays is very different. It's a very different world nowadays. And that's stop loss can really save you a lot of headache. And it can help you to just make sure that you're not losing your shirt. In bear markets, you want to limit losses by setting stop loss orders to minimize downside risk. Um, and in bull markets, you protect gains by setting stop loss orders to automatically sell if prices drop. So they can really be a lifesaver, but be careful with them because if you get liquidated, that's your fault. Tip 8, explore alternative investments. In bull markets, you want to consider real estate, commodities, and international markets for additional growth. In bear markets, you want to look into bonds, gold, and other safe haven investments to preserve capital. Why do you want to do this? Because this is where you store the money. You don't keep it on the mattress, you keep it in assets so that it grows into the future. And tip 9, take advantage of tax strategies. In bull markets, you want to utilize tax efficiently and as an investment vehicle to maximize after tax returns. And in bear markets, you want to harvest tax losses to offset gains and reduce taxable income. So again, those are two things that a CPA or a probably an accountant more than anything would be better explaining to you than me. But it all really depends on how much money you made, how much money you have investment, how long you've had that money invested in, and just what's going to happen with how much you sold. Is it a taxable event, so to speak? And that's what you have to figure out, especially in this world of crypto. Now, a taxable event can be any sort of period of time when the asset changes from one category to another, meaning that if, for example, I take my fiat dollar and I put it into Coinbase, for example, I already have committed a taxable event once that money goes from um, dollars to Bitcoin. That's already now in the Bitcoin system. If I sell that Bitcoin within 1 year, it is taxed at a certain amount. If I sell it 1 year and a day, it's taxed at a different amount. So understanding that can see a lot of headache. You think you're making a lot of wins and a lot of gains by like, playing this day trading thing, but you really are going to end up losing all of it because you didn't do your math on the taxes at the end of the year. So investing is a long-term game. If anybody tells you that you can get rich overnight with investing, they're trying to scam you and they're trying to get you into some sort of Ponzi scheme. So be careful, be wary, be very perceptive of some advertisers and ads. Today, actually, of all days, there just broke a story that a lot of financial influencers promoted a particular alternative coin and it rug pulled, meaning that someone took all the money. So that's a risk in the crypto world, not so much in the stock world, but we have fraud and I'm sure corruption all through the stock exchange. It's just a matter of investing in good companies and understanding what companies know how to do good business. All right. Tip number 10, keep emotions in check. And this is probably the hardest one and probably the one that I struggle with the most sometimes. That's why I live off the policy of set it and forget it. I do my research, do my research, do my research, do my research. And once I made my decision, I pull the trigger and then that's it. I don't think about it ever again. And it's out of sight, out of mind, and I'll let it ride. So that's really worked for me well. It helps prevent panic selling and it really has made it easier for me to keep long-term investments in a safe spot because they're out of sight, out of mind, and there isn't that temptation there to go in and pig out when funds are available. You can actually build something for the future. In bull markets, you want to avoid fear of missing out, FOMO, and stick to your investment plan. Remember the plan. Remember what your goals were when you started out on this journey. And in bull markets, resist the urge to panic sell. Make decisions based on logic and research. That is really the biggest asset that you read outside in the world will give you more information than your own feeling and your own gut. If anything you read, anything that you come across, any news story, any article that brings you an uneasy feeling about your stock investments, I would start looking into it. I would start, maybe finding out why it is that you're feeling this sort of way. Follow your instincts on some of these choices that you make, and you'll realize that you're actually maybe gravitating towards things that might be good for you. Now, test these waters because investments always can go south. And in the stock market, I've seen a lot of friends lose a lot of money, especially in the Forex trade. There were a lot of people that got roped up into several schemes in Forex. And Forex in itself is not a scheme. Forex is foreign exchange trading, where basically you take one currency and trade it for another, like crypto, like any other exchange. But basically, you take money from one country and trade it into another. When countries are doing well, money trades for more money in other countries. When countries are doing bad, money trades for less money in other countries. So, for example, good example right now would be Japan. Japan is at an all-time high compared to the dollar. $1 here gets you $1.65 in Japan. So that's pretty powerful in Japan, especially how popular Japan is. It's brought huge amounts of tourism into the country, and it really has helped the economy, but it has also brought cultural problems as well, where we're having certain cities just shut down tourists because it's affecting the culture. Ah, I know that was a lot, guys. I can't believe so many of you hung through that. Really, you guys are rock stars. If you want a recap on all of this, I'd be more than happy to do a more detailed. We're talking about your investment in bear and bull market. And that's when things are when things are diversify your portfolio. Tip two was maintain long-term perspective. Five was rebalance your portfolio. Tip six was invest in quality. Tip seven was use stop loss orders. Tip eight was investments. Tip nine was take advantage of tax strategies. And tip 10 was keep emotions in check. I'm a master of that, aren't I? Ladies and gentlemen, thank you so much for hanging out with me. You guys are awesome. Again, I can't believe so many of you hung out for that. That was a really good lesson. So thank you so much. I'm going to be back in a few minutes. I'm going to get some water and we will talk about real estate, my job. Maybe I should do my actual job for once. And we'll talk about real estate for a second. And that'll be that. I hope you all are having a great fourth. I can't believe it's another year, another day. But here we go again. I'll see you.